This is your LMAX exchange technical update for Tuesday, May 16th, 2017. Euro dollar. So the euro is looking to push up to a fresh 2017 high on Tuesday, though at this point it would be difficult to see the market extend much further towards its next key objective, which comes in all the way up at 114. It would appear, given the run that we've seen, that we could still see some choppy consolidation and even the possibility for a more significant correction to the downside before the market considers that next significant move higher towards the 114 objective. That 114 objective comes after the market had based out in 2017 off a 14-year low at 103.41, putting in an inverse head and shoulders formation. That range that we had seen while the inverse head and shoulders formed projects now that same move equal size up towards 114. But again, even if we do establish above the previous 2017 high from the other week, it looks like the market could see some choppy trade before we see an acceleration towards 114. So be careful right now if you're looking to be aggressively buying euro dollar. If we see a breakdown back below recent support, which comes in around 109.23, the low that we saw yesterday on Monday, that would take the immediate pressure off the top side and suggest that the market could indeed be looking for a more significant correction before going higher. Again, several days back we saw that gap between the 107 area to the 109 area, and it still is open between 107.30 and 108.30 or 108.20 roughly, which does still leave the possibility that that gap will be filled before the market looks to head higher. So while the market is extremely constructive medium term, and while the euro is rallying on a shorter term basis, there is still risk that the market sees some choppy price action and a bit of a consolidation, a little bit more of a consolidation, and potentially a little bit more lower than we've seen already before the market pushes higher. Sterling dollar. So cable has seen a very nice consolidation above that previous resistance at 127.75 that had capped gains for so long after basing out by plus 30-year lows back in October of 2016. The consolidation above is a bullish consolidation and opens the door now for that next measured move in this market up towards the 135 area. At the same time, just like with the euro, while we could see the market push up a little bit more on a short-term basis, there is risk that we see a bit more of a correction to the downside before the market looks to make a healthy run towards 135. If we do see setbacks, they should be very well supported now into the 125 area, with a firm buy on dip strategy now adopted following the breakout above 27.75, with only a breakdown below recent support that comes in around 23.60 going back to April, earlier in April, to compromise the constructive outlook, this newly adopted constructive outlook for the pound. So the key takeaway right now is that if we do break up to a fresh 2017 high and towards and through 130, those gains may not be sustained, with the market maybe preferring to see a more significant correction to the downside before it makes its move towards 135. Dollar yen. So dollar yen has been in the process of consolidating after a recent run of gains off that 2017 low just shy of 108, but with the market trading between 112 and 115.60, we're in a bit of a neutral zone here when there's no clear directional insight. The market would need to establish back above 115.60, a previous range high from earlier this year, to put the focus more on the top side, and the market at this point would need to break back below some support at 112.09, or we can call it 112, to put the pressure back on the downside. Anything right now in between is just some choppy consolidation with the market in a neutral zone. Euro Swiss. So Euro Swiss has stalled out after the market tried to get up towards that psychological barrier at 110, which is proving to be a stiff resistance level. At this point, if the market establishes above 110, it will signal a more significant shift in the structure, potentially opening medium-term upside towards the next key objective in the 114 area. If, on the other hand, the market can't establish above 110, we could see a topside failure that results in a breakdown back towards recent range lows towards 106. Aussie dollar. So Aussie is seeing a nice little bounce over the past several sessions, but again, this is a market that continues to show signs of topping out, very well capped into rallies, with a lower top now sought out ahead of a resumption of declines back down below recent lows and towards some medium-term support, which comes in from December of 2016 at 71.60. Only back above 76.11 would compromise the bearish outlook for Aussie dollar. Dollar CAD. So dollar CAD is seeing a bit of a correction play out, the onset of an overdue correction in this market following a surge up towards fresh 2017 highs, just shy of 138. This correction could extend some more over the coming sessions, but a higher low is sought out, with the market still retaining its highly constructive outlook. That higher low somewhere ideally in the 134 area in favor of the next push beyond the recent highs and towards the next key psychological barrier at 140 further up. Only back below 132.20 would compromise the bullish outlook for dollar CAD. Kiwi dollar. So Kiwi is seeing a bit of a bounce out from its recent 2017 low, but with this market, any rallies here should be very well capped as the structure continues to show signs of topping out. Well capped ideally into the 70 area and certainly below 71. Only a breakback above 71 here would compromise the bearish outlook for Kiwi dollar. SPX 500. So the S&P 500 is consolidating after a fresh push to record highs in recent days, which does open the door for a measured move up towards the 2480 area in the weeks ahead. If we see that the recent record run to 2400 back in early March down to the correction of 2320 into late March, that 80-point move, if we consider that move, the breakout now would project approximately 80 points to the top side, which takes us up to 2480 into that area. At this point, only back below 2322 would compromise the highly constructive outlook for the S&P 500 on a short-term basis. If the market were able to break that back down below 2380, it would take the immediate pressure off the top side. But again, while the market holds above 2320, the market continues to favor additional record high gains. Gold. So gold has been very well supported since basing out in 2016, and despite a recent run of setbacks and weakness, the market could be looking to put in a higher low in continuation of this higher low and higher high pattern that we've seen since the low in 2016. So it is possible the market is going to want to put in a higher low now here after basing out above the previous higher low. Setbacks recently stalled out around 1215, and that will be confirmed on a breakback above the 2017 high at 1295, which should then expose a retest of the 2016 peak at 1375 further up. Only back below that recent higher low that comes in at 1195 would compromise this constructive outlook for gold.